So far in our discussion of the accounting cycle, we have analyzed the accounting equation. We have created journal entries to record those effects. We have posted the effects of the journal entries into T accounts. We have created trial balances to outline all the summaries of the T accounts where these are equal. And we've moved that information from the trial balance over to financial statements that are ultimately used to analyze a company. While we have noted that financial accounting utilizes an accrual basis of accounting, and that the revenue recognition principle and expense recognition principle says that cash and revenue or cash and expenses doesn't have to be the same thing, most of our journal entries surrounding these first three processes have been involving cash. Today we're going to talk about a special type of journal entry referred to as an AJE, or adjusting journal entry. And this type of journal entry does not involve cash. Adjusting journal entries are utilized primarily to focus on the revenue and expense recognition principles, and we're going to talk about when they take place and how they differ from the journal entries that we've learned so far. In order to contrast, we'll go ahead and call these journal entries over here on the left the original or daily journal entries. And then we'll refer to the ones on the right as an adjusting journal entry. And you'll see how they contrast here in a minute. One thing to note is that you are actually already familiar with some adjusting journal entries. We actually talked about them in Chapter 3. We just didn't refer to them as adjusting journal entries. So as we move along, I'll point those out. To begin our discussion of adjusting journal entries, let's talk about some broad strokes. First of all, the purpose or the why for adjusting journal entries is to ensure that the financial statements are aligned with the expense and revenue recognition principles. Remember that adjusting journal entries don't involve cash. And so mainly what we're going to be doing is looking for transactions that don't involve cash but have taken place in substance but haven't yet been recorded, and we're going to refer to these as accruals, or transactions that have been previously recorded with a daily journal entry but have been postponed to the balance sheet and now need to be adjusted to show the expense and revenue recognitions in substance, and we're going to refer to those as deferrals. Adjusting journal entries take place at the end of a period. You'll notice their location that we have in this accounting cycle process. They take place right before our financial statements are actually created. Previously, the financial statements that we were creating, we would have referred to as the unadjusted financial statement, and we would have referred to the trial balance as the unadjusted trial balance. What you'll find is when we actually do our adjusting journal entries, we actually repeat these first four processes again, but doing so for the adjusting journal entries. So we'll analyze potential transactions, we'll record those transactions with a adjusting journal entry, then we will summarize the transactions with T accounts, and then ultimately create what we call an adjusted trial balance. So we'll go through those four steps again. It takes place at the end of the period because what you're going to find is, number one, it's only cost beneficial for us to do certain types of journal entries like adjusting journal entries at the end of the period. You're going to find that if we were to do them on a daily basis, it would be very cumbersome. Number two, the information of adjusting journal entries actually turns out to be most beneficial or beneficial enough to overcome the cost of preparing them once we're creating the financial statements. So the idea is that to include the information in the financial statements is extremely beneficial, but to include it before is too cumbersome. So we create adjusting journal entries only at the very end of the period, right before we produce our financial statements. As I mentioned previously, there are two types of adjusting journal entries that we'll talk about. They are deferrals and accruals. And we'll mention the difference between each of them here in a moment. Finally, the where piece here with our broad strokes about AJEs is that the adjusting journal entries are going to impact both the balance sheet, remember this B/S is abbreviation for balance sheet, and the income statement. This I/S is abbreviation for income statement. Our journal entries that we're going to do for AJEs are going to have a component that affects both the balance sheet and the income statement, regardless if we're talking about a deferral or accrual. So to recap, adjusting journal entries take place at the end of a period, right before we create our financial statements. When we do them, we will analyze potential transactions, record the adjusting journal entry, summarize those effects in the T account, and then create what we call an adjusted trial balance, which will ultimately then be used to create the financial statements. The purpose or the why for the adjusting journal entries is to ensure that financial statements are aligned with the expense and revenue recognition principles. We'll find that most of our daily journal entries involve cash. And so at the end of the period, we check for potential journal entries that haven't involved cash. Remember, AJEs don't involve cash, but need to be recorded. We record those adjusting journal entries through two different types. One is a deferral, and the other is an accrual. We'll talk about the difference between these two in our next video, but to highlight it, basically deferrals have a previous daily journal entry that needs to be adjusted now in order to properly reflect the expense and revenue recognition principles, whereas accruals have never previously been recorded, but something in substance exists because of the expense or revenue recognition principle, and we need to then make an adjustment. Finally, the where piece, or where we can see the impacts of the AJEs, are on both the balance sheet and the income statement. You're going to find that your journal entries, the adjusting journal entries, will include at least one account from the balance sheet and one account from the income statement, regardless of the type of the adjusting journal entry, either deferral or accrual.